Welcome, I'm Ernie Goss, research faculty member here at the Craig School of Business at Fresno State University in beautiful Fresno, California. And here we are on the first business day of the month, as we always are, to talk about and discuss our survey for the previous month. Now, this is, of course, our survey of businesses in the four-county area, that's the metropolitan area, what we call the San Joaquin Valley Economic Indicator. Now, what did it look like for the month? Very good. Over growth neutral for the 26th straight month. Of course, that's more than 2 years we've been seeing the upturn in the overall index moving higher, and that's really good, pointing to solid growth. Now, I do expect growth to come down a bit, and it already has come down a bit, but still very positive. Growth in the San Joaquin Valley is much stronger than what we're seeing in the U.S. economy, and our survey is picking it up. Now, the overall number was up to 58.8, and that's from December's 55.6. Those may not sound strong, but they're very strong, certainly compared to the U.S. number that I'll show you momentarily. Construction slowing down a bit. Manufacturing not as strong as we'd like because of the strong dollar. That's hurting manufacturing, of course, but other sectors like wholesale trade, food processing, that's outside of manufacturing. Food processing, that is, of course, a manufacturing company, but that's one that's doing pretty well. Now, here I'm going to bring up and show you the graph for the month of January. And in fact, from October 2014 to January 2016, there you see in red, that's the San Joaquin Valley indicator, and you see there a significant gap between the U.S. number. Now, that's my estimate of the release. It comes out later this morning, and as you see, I expect it to be, it was below growth neutral last month. I expect it to be below growth neutral this month. So the San Joaquin Valley is much stronger than the U.S., pointing to very solid growth. The employment gauge was up to 58.3, and that's from 55.0, and that's, of course, good as well. Inflation drops to 44.1. Now, you might think, hey, that's good. Not really. The Fed is wanting to see more and more inflation. They're fearful that could dip into deflation. I don't share their concern. The next time the Fed meets is in March. I'm on the borderline. I'll tell you for our March video, I'll let you know what I think about the probability of a rate hike later on in the month. New export orders dropped to 38.6, down from 41.5. Of course, that's very weak. We expect that. Almost 100% of the companies said that they haven't really changed their buying imports, so that comes out pretty. Imports are pretty strong there. Now, what should you watch for in the weeks and days and even months ahead? Well, first off, the employment report. Now, I know I say that every month, but keep an eye on that. This comes out this Friday. That's February the 5th. And it's the employment report for January. Now, that number was good last month, 292,000 jobs. Very strong. Of course, the GDP number didn't match that growth. But look at the wage number behind that. See how much wages are growing year over year for the U.S. economy. About 2% is what we've been seeing. If that should tick upward, then you're more likely to see increases in interest rates, short-term interest rates, even without the Fed moving on interest rates. Look at the productivity number, which comes out February the 4th. Why there? Because if that productivity number is coming down, again, that shows upward pressure in prices. And that's what the Fed could move again on interest rates, and you could see higher interest rates on the short end, even without Fed action. Now, the core CPI that comes out for January, that's the month of January, the Bureau of Labor Statistics, for February the 10th will be February the 19th will be releasing that number. Look at the core that pulls out food and energy, and if that number if it begins to increase even more, 2% to 3%, not good on short-term interest rates. And, of course, that's something to be concerned about. What are the risks? Chiefly the value of the dollar. And as you may have heard, the Japanese have now moved into negative interest rate territory. Their central bank is now charging to keep deposits, bank deposits. So that's of course that has increased the value of the dollar against the yen. That's tough for our companies that are selling abroad, makes them less competitive. Keep an eye on the 10-year. I'm sorry, the risk factor. Also, another risk factor is the 10-year Treasury. As that if it should increase, I expect it to be coming down. And what would that be? Something you need to watch out for is short-term rates. Short-term rates getting higher than long-term rates. Now imagine that. Now that's called a flattening of the yield curve. That's a real concern. What does that mean? It means the Fed is getting it wrong. In other words, the market's telling us that inflation is coming down, and the Fed is telling us they're raising rates. So the short end. So you could get what's called an inverted yield, where the short-term rates are higher than long-term rates. That would be a real risk factor out there. So, folks, that's it for the month of January. Our report here. I am on the first business day of the month of February. Ernie Goss with the Craig School of Business here at Fresno State in beautiful Fresno, California, saying, hope from now until the next month we meet again, may your economic cup runneth over. Thank you.